Hello, in this presentation we will define fixed costs. According to Fundamental Accounting Principles Wild 22nd edition, the definition of fixed costs is cost that does not change with changes in the volume of activity. We can compare and contrast fixed costs with variable costs. One way that costs can be broken out, a useful way often used in managerial accounting, often used for decision making. For example, the example of fixed cost is the rent. Good example of fixed cost because the rent will not change from time period to time period, month to month, year to year for the most part. Therefore, no matter how much activity we have in the form of, for example, sales volume or production volume, the rent will still be the same. We can also have salaries if it's maintenance. If they're paying salary for the maintenance, it may be fixed. If we have the supervisor's salary in of itself will be fixed because, again, instead of paying hourly, where the rate will change as more time is put in, when we pay salary, that means that each month it's going to be the same amount no matter how much we produce. We want to compare and contrast that to variable costs, those costs including things like direct labor, oftentimes being an hourly rate. Therefore, direct labor is going to be tied to the production level. If we produce more stuff, the idea being that we're going to need more direct labor. Therefore, the variable costs will go up as we produce more things. Variable costs in total will go up as we produce more things. Variable cost per unit will remain the same. If we pay $10 per unit to produce a particular item in terms of the variable cost with labor, we expect that to be roughly the same for each particular unit, and therefore total costs to go up at a constant rate. On the fixed costs side, if we make the fixed costs will stay the same no matter how many units we make, meaning that the fixed cost per unit will actually go down. So if we make one item and we have $1,000 rent, then that $1,000 can be allocated to that one unit that was produced. If we make two items, now we have 500 each, and so on. So as we produce more, we actually have a lower cost per unit in terms of fixed costs, and an equal cost per unit for variable costs. Direct materials often being the other portion of the variable costs.